They just admitted it, not in a press release, not on a government website, but in the fine print of a $27 billion deal that is now racing toward completion. The truth about Iraq's future has been quietly confirmed for over a decade. This project was declared dead. Critics called it impossible. Skeptics said Iraq would never allow it. ExxonMobil walked away. CNPC stalled. The entire international energy community assumed this megaproject would join the graveyard of failed Iraqi ambitions. But this morning, new data from inside the oil ministry confirms that the TotalEnergies deal is not only alive, it is between 80 and 95% complete, and the implications for the Iraqi Dinar are staggering. Let me be absolutely clear about what this means. The $27 billion TotalEnergies megaproject is not simply another oil contract. It is the single most important economic development in Iraq since the 2003 invasion. It is a four-pronged infrastructure revolution that includes a massive seawater supply project to maintain reservoir pressure, a gas capture initiative that will end Iraq's dependence on Iranian energy imports, a petrochemicals component that will generate an estimated $100 billion in profits over 35 years, and an export pipeline expansion that will double Iraq's capacity to move oil to global markets. This is not incremental improvement. This is a complete restructuring of Iraq's productive capacity, and it is happening right now. For those who have been watching the dinar patiently, you understand that currency value is ultimately a reflection of a nation's ability to produce, to export, and to generate wealth. Iraq currently produces between 4 and 4.2 million barrels of oil per day. That number has been stagnant for years. But the Integrated National Energy Strategy, developed over a decade ago, outlined what was possible if Iraq could overcome its political paralysis. The best-case scenario projected production capacity of 13 million barrels per day. The mid-range scenario projected 9 million. The worst-case scenario projected 6 million. We are currently at the worst-case scenario. And now, the $27 billion megaproject is the vehicle that will drive Iraq from 4 million to 9 million, and potentially beyond. Let me repeat that number. 9 million barrels per day. At current global oil prices hovering around $60 per barrel, that is not incremental revenue. That is transformational revenue. That is $540 million per day. That is nearly $200 billion per year. That is a GDP multiplier that makes the current exchange rate of 1,320 dinar to the dollar not merely undervalued, but mathematically absurd. Now, let us address the ExxonMobil signal that nobody in the mainstream financial press is connecting to this story. ExxonMobil was originally the primary contender for the Common Seawater Supply Project, the centerpiece of Iraq's production expansion. They spent years in negotiations. They conducted feasibility studies. They positioned themselves to dominate Iraq's energy future. And then, they walked away. The official narrative was that Exxon withdrew due to corruption concerns, lack of transparency, and the impossible bureaucracy of Iraqi governance. But that narrative is incomplete. ExxonMobil did not walk away because Iraq was too difficult. ExxonMobil walked away because they understood something that the market has not yet priced in. They understood that the terms of engagement in Iraq were about to shift fundamentally. They understood that the era of easy extraction contracts with minimal domestic reinvestment was ending. They understood that Iraq was no longer willing to be simply a colony of Western energy companies extracting raw crude with no value retention inside the country. ExxonMobil looked at the future of Iraqi energy sovereignty and realized that the old model was dead. So they sold their assets. They redeployed capital elsewhere. And they left the door open for TotalEnergies and Chinese National Petroleum Corporation, a fight over the scraps. But here is what the market missed. ExxonMobil's exit was not a vote of no confidence in Iraq's resource potential. It was a vote of no confidence in the old extractive model. And in its place, a new model has emerged. Total Energies is not simply extracting oil. They are building permanent infrastructure. They are capturing gas that has been flared for decades, wasting billions of dollars of potential revenue and poisoning the southern skies of Iraq. They are constructing processing facilities that will allow Iraq to refine its own petroleum products and export finished goods rather than raw crude. They are laying the foundation for Iraqi energy independence. The February 8 commissioning of the Salah al-Din and North Refinery projects, adding 140,000 barrels per day of fresh distillation capacity, is not a coincidence. The new fluid catalytic cracking unit at the Basra refinery, producing high-octane gasoline from heavier streams, is not a coincidence. The Euro 5 fuel standards that Iraq is now meeting for the first time in its history are not a coincidence. This is the downstream infrastructure that transforms an oil exporter into an energy powerhouse. This is the value capture that justifies a currency revaluation. And yet, the mainstream narrative remains fixated on the parallel market rate, which has recently climbed to 151,000 dinar per $100. They look at the street price of the currency and conclude that the dinar is weakening. They look at the protests of Baghdad traders, shutting down their shops and hanging banners that red customs fees are killing citizens. They look at the central bank governor, Alak, explicitly stating that the bank is not studying the topic of changing the exchange rate. And they conclude that the revaluation thesis is dead. This is the mistake that keeps retail investors on the sidelines, while institutional money positions itself for the largest currency adjustment of the decade. Let me decode the Alak interview for you, because it is the most important signal you will receive this month. The governor stated that the central bank has no plans to change the exchange rate. He stated that any link between the exchange rate and the budget deficit is an incorrect link. He stated that the reserves are at a very comfortable level and that the bank faces no difficulty in responding to demand for foreign currency. To the untrained ear, this sounds like a definitive denial. To those who understand central bank communication strategy, this is the standard script executed perfectly. A central bank that is planning to devalue its currency never announces it in advance. They do it suddenly, usually on a weekend, to prevent capital flight. A central bank that is planning to revalue its currency also never announces it in advance. They deny, they deflect, they stabilize expectations downward, and then they act when the infrastructure is ready and the market is looking the other way. Alak is not lying. He is stating the current operational reality. The bank is not studying a change today. But today is not the day of the change. The change comes when the budget is locked in, when the customs systems are fully implemented, when the oil production targets are within reach, and when the $27 billion mega project is complete enough to justify the new valuation. Now, let us examine the customs reforms that the governor explicitly endorsed. He stated unequivocally that the government is proceeding with the Asacuta system, the Advanced Customs Declaration, and the new tariff structure. He called these measures beneficial beyond fiscal gains. This is not the language of a central banker who expects the currency to weaken. This is the language of a central banker who expects the currency to strengthen. Why are customs reforms critical to the revaluation thesis? Because for decades, Iraq bled wealth through its porous borders. Goods were undervalued, tariffs were evaded, and dollars flowed out of the country through systematic overinvoicing and trade-based money laundering. The new customs regime is the tourniquet. It stops the hemorrhage. It forces importers to pay legitimate duties, which increases government revenue. It forces traders to document their transactions, which brings them into the formal banking system. It forces the parallel economy into the light, which expands the tax base and reduces the demand for illicit dollars. The traders are protesting precisely because the system is working. They are losing the arbitrage. They are losing the ability to move money outside the government's visibility. They are losing the competitive advantage that smuggling and evasion provided. Their protests are not evidence of a failing policy, They are evidence of a successful one. Now, let us turn to the West Kurnitu story that the Western financial press has largely ignored. In January, the Iraqi cabinet approved the short-term nationalization of this giant field, operated by Russia's Lukoil, to avoid production disruptions caused by U.S. sanctions. This is not an isolated incident. This is a pattern. Iraq is systematically taking control of its own energy destiny. They are not allowing foreign sanctions regimes to dictate their production levels. They are not allowing foreign companies to hold them hostage to geopolitical conflicts. They are asserting sovereignty over their most valuable asset. The West Kurnitu field produces approximately 465,000 to 480,000 barrels per day, nearly 9% of Iraq's total output. When the Iraqi government steps in to operate a field of this size, they are demonstrating technical competence and administrative capacity that did not exist a decade ago. They are proving that they can manage complex industrial assets without foreign operators. They are building the institutional muscle that a sovereign nation requires. This is the same institutional capacity that will manage the currency revaluation. The same Ministry of Oil that is successfully nationalizing West Kurnitu is coordinating with the central bank and the Ministry of Finance on the 2026 budget, which is calculated at the 1,320 dinar rate. They are not amateurs. They are not the corrupt, incompetent bureaucracy of the 2000s. They are professionalized technocracy executing a multi-year plan to restore Iraqi economic sovereignty. Let me speak directly to the psychological barrier that keeps most investors paralyzed. You look at the official rate, unchanged for years. You look at the parallel rate, climbing higher. You look at the governor's denials. You look at the trader protests. And you conclude that nothing is changing. This is the optical illusion of incremental reform. Change happening slowly looks identical to no change at all. But, beneath the surface, the tectonic plates are shifting. The United States and Iraq are meeting quarterly to discuss banking reform and financial stability. The February 5th meeting between Governor Alak and U.S. Chargé d'Affaires Joshua Harris produced a statement affirming America's whole readiness to continue supporting the efforts of the Central Bank of Iraq, enabling it to achieve its goals in enhancing financial and monetary stability. The United States does not expend political capital on failing states with worthless currencies. They support allies with strategic value and economic potential. They support partners who are compliant with international financial standards and cooperative with counterterrorism financing efforts. Iraq has become that partner. Consider the timeline. The TotalEnergies mega project is scheduled for completion around 2028. The refinery expansions are coming online now. The customs system is being implemented despite protests. The West Kurnitu transition is underway. The gold reserves now exceed 76 tons, with foreign reserves over $100 billion. The money supply is approximately 100 trillion dinar, with over 80% held outside the banking system. This is not a static picture. This is a nation in the final stages of preparation for a fundamental monetary reset. When that reset occurs, the institutions will capture the spread. The retail window will open and close in milliseconds. The algorithms will repaint the charts instantaneously, and the mainstream financial media will run headlines asking how this could have happened without anyone noticing. But you are noticing. You are reading this analysis. You are connecting the $27 billion pipeline to the ExxonMobil signal, to the central bank's denials, to the customs reforms, to the refinery expansions. You are seeing the pattern that the market has not yet priced in. The traders are protesting because they know the old system is dying. The governor is denying because he knows the new system is not yet ready for public announcement. ExxonMobil exited because they knew the extractive model was over. TotalEnergies enter because they recognized the infrastructure model was the future. Lukoil is being nationalized because Iraq no longer needs foreign operators to manage its core assets. Every single one of these signals points to the same conclusion. Iraq is preparing its currency for a fundamental revaluation. The only question is whether you will be positioned when the signal becomes a headline. They just admitted it. Not in words, but in action. The $27 billion pipeline is nearly complete. ExxonMobil is gone. Total Energies is building the future. The dinar is waiting for its moment. That moment is closer than the market believes.